Hello my fellow investors and welcome back to another stock analysis video. Today we're going to analyze Warrior Met Coal, which was brought up by Tony Myers. This is a company, guys, that mine coal. So it's a pretty basic industry, right? Just mining coal, that's about it, and then they sell it. So this will be rather interesting to see because, well, remember, companies that mine a certain commodity, they pretty much follow that commodity. And coal is very, very interesting. I'll show you guys the graph in just one second. But with that said, let's get started with this analysis. All right, guys, before we actually get on to the company itself when it comes to like the numbers, let's actually see their earnings report because they had it just last month, November 2nd, 2022. EPS normalized actual came in at $2.10, which was a beat by 38 cents. EPS gap actual came in at $1.90, beat by 6 cents. Revenue came in at $390.18 million, which was a beat by $19.44 million. So now with that said, let's actually come over here to the calculator. We got the ticker symbol for HCC, market cap of almost $2 billion, a PE of 2.75, very, very tiny, with a current share price of $36.25. Now looking at this graph on the 1 year, guys, they're up a whopping 47.52% on the year to date. They're up 47.64%, so pretty much 50% on the year to date and the 1 year. And take a look at this 52-week range, a low of $23.79 to $41.33. Guys, at the current share price of $36.28, this is definitely looking like we're on the higher end of this 52-week range. Now remember what I said, that when it comes to companies that mine or that sell a specific commodity, you definitely have to take a look at the futures in regards to this commodity. And I have pulled up here, guys, coal futures, and this is insane. Take a look at this on the 1 year, up 136.37%. Dear Lord, year to date, it's even higher, 154.38%. Absolutely crazy. And by the way, that's not even the peak. On the 52-week ranges of coal, we got $157.50 to a high of $457.80. In fact, you can even take a look at this range. You can see where that dot is. It pretty much matches the same as Warrior Coal, where we're definitely on the higher end of this range. So based off of that, guys, this company is not at the 52-week low, but that doesn't mean that it's still not a buy. They do pay out a dividend of 24 cents per share, which is a yield, a really small yield of 0.65%, a payout ratio of 1.63, a 5-year CAGR of 19.14, and 1 consecutive year of dividend growth. Now this is a little bit misleading because when you take a look at the dividend history, well, they only have 5 instances where they paid out that dividend. As you can see, I have here on the max, they paid it out on November 23rd, 2017, April 11th, 2018, May 2nd, 2019, May 11th, 2022, and August 18th, 2022. So yeah, we may have a really big CAGR, but guys, it's just not consistent at all. Ex-dividend date passed as of November 3rd, payout date was on the 11th, and they pay their dividends quarterly. And also, based off of the current shares outstanding, they pay out only $12.41 million in dividends every single year. And then in regards to the 5-year average free cash flow, they're still left with almost $300 million, and as of their last year's free cash flow, it is $281 million. These payout ratios are 4.23 for the last year's free cash flow and 4.02 for the 5-year average. Now coming into the fundamentals, we got the net income 5 years ago of $455 million, 1 year ago of $151 million. That is a decrease of 67%. And not only that, guys, take a look at this. Even though COVID year was the worst year that they had at negative $35.8 million, take a look at this. From 4 to 3, they were actually going down, and well, their lowest was 2 years ago, but then as of 1 year ago, they went up, probably because of the fact that coal prices just shot up massively. So I'm gonna have to give this like a 30%. Coming down into the free cash flow, we see something very, very similar. 5 years ago of $342 million to 1 year ago of $294 million, increase of 14%, with an average of $308.78 million. Again, 4 to 2 years ago, massive decrease, and then 2 years ago was the lowest point point at $25.1 million, and then they shot right back up the following year. So I'm gonna have to give this guys pretty much a 30%. Looking now at the revenue, once again, exact same thing that we have been seeing. 5 years ago of 1.2 billion to 1 year ago of 1.1 billion. That's a decrease of almost 9%. And take a look at this. Once again, 4 to 3 to 2 decrease, and then from 2 to 1, they shot back up a little bit. So once again, guys, I'm gonna give it a 30%. In the form of assets minus liabilities, this one actually isn't looking too bad. Currently, they're at $1.3 billion. However, that is a pretty big jump from last year's $872 million. And take a look at this. They did go down 2 years ago because of COVID, but you can see that that was the outlier year, from 5 to 4 to 3, consistently increasing, dipped a little bit during COVID, then shot back up, actually pretty well matching the 3 year ago value. However, massive jump from 1 year ago to today. Average total assets is $1.51 billion. Average liabilities is $622 million. And doing this difference, we get $885 million. I'm gonna have to give this guys like an 80%. Coming now into the cash flow minus the liabilities, this one's all over the place. They have had instances where they brought it right back up, very, very close to zero, like 4 years ago, and then 2 years ago, where it was the lowest point. However, again, COVID related. I'm not gonna fault them for that. Now, because the fact that they have instances where they have shot it up closer to zero, I'm going to give it a pretty decent grade. Average cash flow minus the average liabilities, we get negative $313.2 million. I'm gonna have to give this guys like a 75%. In the form of the shares outstanding, this one's rather interesting because in the 5 year they are decreasing, but on the previous to the current year, they are actually increasing it. 5 years ago of 53.3 million shares to today of 51.7 million shares. Take a look at this. From 5 to 4 to 3, they actually brought it down. Now from 3 to 2 to 1 to today, they're actually bringing it up. So that is definitely something of concern. Obviously on the 5 year, they're decreasing it by 3%. And on the previous year to the current year, they have issued around 0.6%. I'm gonna have to give this like a 70%, mainly because sure, they are down in the 5 year, but you can clearly see that from 3 to today, they are slightly increasing it. And lastly, when it comes to the cash and equivalents, they currently hold $745.7 million with an average of almost $300 million. Looking now at the overall grade, we give the net income 30%, free cash flow 30%, revenue 30%, assets minus liabilities 80%, cash flow minus liabilities 75%, and the shares outstanding of 70% for an overall grade of 46%. The main issue here, guys, is definitely these profit metrics. They're just all over the place. And sure, if it was like a COVID related problem, I wouldn't have dinged it so much. But the fact that I saw from 4 to 3 to 2 years ago consistent decrease, that's why I gave it a 30% overall for an overall grade of, once again, 46%. So now guys, let's actually see if at the current share price of $36.28, this is looking like a pretty good buy. So let's make low, medium, and high assumptions. Revenue growth, predicted share buyback, and the required rate of return, which I like to keep flat at 10%. Now let's come over here to Seeking Alpha and see that the forward revenue growth is almost 20%. I personally do not believe this. I'm going to go significantly lower because again, remember, when it comes to companies like these, their profits are going to be directly related to their corresponding commodity. So I don't believe coal is going to keep rising at this rate like we have seen. So for that reason, I'm going to go with a revenue of 7%, 8%, and 9%. Now for the predicted share buyback, we have been seeing that they have been issuing since 3 years ago. So let's actually make that a thing. Let's put in -3, let's put in -2, and -1%. Negative just means that they're issuing, right? So now with that, we do get some target share prices, $37.22 all the way up to $40.62. Target share price is now adjusting for debt. It is $88.43 all the way up to $95.52 with a margin of safety of 5, 10, and 15%. This is between $75.17 to $90.74. Guys, take a look at this. By all measures, pretty much, we are there. I mean, even at the lowest assumption, not adjusting for debt, the target share price is $37. So we are essentially $1 off from the lowest share price that we could possibly buy this company if we assume that their revenue growth will grow at 7%, issue 3% of shares, and we want a required rate of return of 10%. This is what price you would need to buy this company at in order to get this 10%, assuming these two numbers over here. The fact that we're lower than this, yeah, pretty much is telling me that across the board, this is looking like an all-out buy. However, as I always say in every single video, please make your own due diligence when buying into any company. That's why I have these calculators available for free. Please have them. I do not want you guys to just follow me blindly, because this is not financial advice. I'm just showing you guys the process and how you should go about analyzing companies. That's pretty much it. How to identify which companies are good, which companies are bad, and what price should you buy for them if you like their fundamentals. I personally do not like this company's fundamentals as per my weighted grade, but that's my opinion. If you guys do like it and you put in your own assumptions and you find that, oh, this is a really good price today, then you make that decision for yourselves. Again, these calculators are all available for free for that specific reason. Also have the book value calculator, the reevaluation, as well as a dividend tracking sheet for everybody to have for free, because I don't believe in any paywalls or anything like that. Like, if I were to charge you guys for something, it'll be something tangible, like a mug. Like I always said, like if I have a sponsorship, it'll be like safe and ready meals, right? Something that you guys could actually use. I'm not a fan of like any of these things of like, oh yeah, you go here and you get like a free stock for using my link or whatever. I'm not a fan of that. I really am not. So please, the best way that you guys could help me just in my endeavors when it comes to YouTube is just help me grow my channel. It's just like, subscribe, comment. It really does help here, guys. And also share with your friends. I mean, the market has been tumbling pretty bad recently. At least yesterday it was very, very bad. Today it's actually up a decent amount, but yesterday it went down like 3%, which is crazy. It presented like a really good opportunity to buy a couple things, and if you guys had the correct mindset to actually buy at that point when things are crashing, then you probably made out like a bandit. Again, that's kind of the lesson that I'm trying to teach everybody here. So the best way that you guys can help me is just like, subscribe, comment, and of course share with people who may want to learn how to invest in these kinds of times. Now let's actually come over here to this dividends at the current price, because 24 cents isn't a lot, but let's just entertain this. Putting in $5,725, this nets you 157.81 shares for an annual dividends of $37.87. Guys, I think you could do a whole lot better. There are other companies out there that pay out a much more bigger dividend. However, if you're not interested in this company for a dividend itself, this is still looking like a pretty good buy in accordance to my assumptions. All in all, thank you so much for this company suggestion, Tony. I personally think that there are better ones out there, at least when it comes to their fundamentals and even a dividend, but based off of my assumptions, they are looking like a pretty good buy today. But then again, 2 of the 3 aren't making it for me, so for me, it's a pass. But tell me what you think in the comment section below. That pretty much does it for this video. Like if you like, comment, subscribe, as I just said. You guys can follow me on my new tech sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.